once again, it is a confounding report of somewhat towards a fully employed America. Is this the productivity overlay? Is this the technology overlay into non-technological sectors where things are just simply better than we perceive?
Well, it's hard to say, Tom. I mean, the productivity statistics have been really strong over the last 2 quarters, but they were insanely weak before that. So on productivity, we just vaulted back to the pre-pandemic trend so far, which was 1.6% per annum. So to be determined on that question. This is a good report. Almost 200K with the downward revisions, we're at or just below the consensus expectation. But we were talking about the unemployment rate moving up to the cusp of a recession signal. Now we've pulled back to 3.7 on the unemployment rate. So this is a report the Fed is going to look at and not really feel compelled that they need to embrace these early rate cuts next year that the market has priced in. Now, this could change again with the December data, obviously, but at face value, strong report, almost 200K on payrolls, unemployment ticks by 0.2 to 3.7. That's going to be viewed as still a very tight, fully employed labor market. And so, it makes sense that we're seeing a bit of risk off here and a bit of a bounce in bond yields.
Michael, does this make you rethink any of your thesis about the business cycle rolling over?
Not so far. I mean, certainly it's not an additive, decisive signal that, okay, this is, if we're up above 4 for this report, then, to me, that would suggest that perhaps we've fallen into recession. So this says we're not in recession right now, but it's not necessarily an all clear signal for next year either.